Well, hi everyone. Good evening. A very warm welcome to everyone joining our event today. So, if you're here, I'm sure you know the title of our event for tonight already. We're really going to be covering the future of Web3 and Metaverse. Really excited to be here today with you all. My name is Shuo Chen. I was pulled in relatively last minute to also moderate the event in addition to hopefully pitching in on some of the ideas, but hopefully we'll do a good job and have a really fun, lively discussion with our amazing panelists here today. A special thank you to the event organizers, Silicon Valley Crypto Club, as well as the Duke University MBA Blockchain Club, and also to our event sponsor, Shadow Killers. Obviously, we're live streaming now on YouTube, but all of you are very welcome to leave messages, comments, anywhere you're able to share input to ask questions. And I know we have organizers that are monitoring chat live to ping us any questions that you might have directly. So to start with a very brief self-intro, again, my name is Shuo. You can think of it like shushing someone and saying, whoa, she's awesome, Shuo. I am a general partner at IOVC, where we focus on investing in early stage startups powering the future of work, predominantly focused on B2B enterprise SaaS, though we have invested in a number of blockchain-enabled startups that have since been acquired. And outside of that, have been on the faculty at UC Berkeley under College of Engineering. I've been teaching entrepreneurship and blockchain for a while, actually since 2015. So really eager to chat with you all a little bit more about the upside and exciting opportunities, but also the challenges and downside from all the conversations that we've had with students and executives, as well as startups that we've seen so far. Would also love to introduce our amazing panelists here today. It's a real treat to get this group of amazing people together. And the benefit of virtual is we get to bring everyone across the world together. As some of you might have heard from when we first started live streaming, we're all dialing in from different parts of the world. So first of all, I would love to have panelists introduce themselves briefly. So first of all, Professor Eric Maskin, over to you.
Well, hello, everyone. I'm Eric Maskin. I'm an economist, a theoretical economist, and I teach at Harvard. I have a special interest in what's called mechanism design, which is how to build mechanisms or institutions that achieve society's goals. Of course, markets do that in part, but markets are not entirely successful all the time. And so mechanism design steps in where markets fail.
William, love to hear your introduction as well.
Okay, well, I'm William Purpura. I'm currently the chairman of the COMEX Governors Committee. COMEX is the largest futures exchange that trades gold and silver trading metals exchange in the world. I've been trading commodities since about 1979, and I've been a COMEX member since 1983. So I've seen a lot of, particularly in the gold and silver markets, in the metal markets, and the energy markets, more on the futures trading, futures regulation, exchange governance, and also I have a company here in Dubai, and we trade physical commodities here, but another company in the U.S. where we trade futures and are involved in that end of the market. Also getting involved a little bit in, we were involved in some interesting projects about tokenizing certain commodities and certain assets. I'm familiar with some of the carbon trading and the tokens that go on over there. So it's been a very interesting world, and I've been very fortunate to see developments, throughout the industry, growing from time when we used to write prices on chalkboards now to where we're doing thousands and thousands of trades in a minute or per second. So it's a very exciting time, and I'm really eager to actually hear from a lot of the other panelists, because I know I'm going to learn a lot more.
Amazing. Thank you, William. And last but not least, Ray.
Hi, everyone. Thanks for having me on. I'm Rayhaneh Sharif-Askary. I lead investor relations for Grayscale Investments. We are the world's largest cryptocurrency asset manager. We create products that take cryptocurrency investing and put it into familiar vehicles and make the experience accessible to people.
Perfect. Well, welcome to Eric, William, and Ray. I think this will be a really fun conversation. In fact, I think it's particularly fun because even though our topic is Web3 and the metaverse, I know, Eric, you in particular have different ideas on the ability of blockchain, or rather both the pros and cons. So it'll be really fun to get into that. So maybe we'll start with this first question really centered around just the underlying structures. So of course, we all know that companies are really just a form in which we see institutions distributing wealth. And of course, there's recent conversations around how people think that it's really not necessarily a fair or equitable structure because it's controlled by the few. So with the emergence of Web3, a lot of people are talking about the power of decentralization to be able to make this entire process of wealth distribution more fair and efficient. But love to get your thoughts on it.
Well, I'm sorry to be probably the solely negative voice on this panel, but I'm afraid that I have to voice some serious concerns about cryptocurrency. It's been suggested that cryptocurrency may be a good way to improve the wealth distribution. I'm afraid I think that just the opposite is true. I think crypto makes the threat of serious inequality even worse. As we've seen, even well-established cryptocurrencies are subject to enormous volatility, enormous swings in value. A sophisticated investor may be able to deal with this volatility. In fact, a sophisticated investor may welcome volatility, but naive investors are another matter. They're likely to be harmed by great variations in value. They don't know when to buy, they don't know when to sell, and timing is everything when it comes to an asset of fluctuating value. So the problem from the standpoint of inequality is that sophistication tends to be highly correlated with wealth. Wealthy, sophisticated investors may well get rich from crypto, many have, but poor, naive investors will tend to become poorer. And so crypto makes the wealth distribution more unequal. But the situation is even worse than that because, as we know, there are many cryptocurrencies that have ended up being worthless. Probably most of them have ended up being worthless. And that means that most cryptocurrencies are like a Ponzi scheme. If you get in early, you may do fine. But if you get in late, your investment is going to be wiped out. And so once again, it's wealthy, sophisticated investors who get there early and succeed, and naive, poor investors who get there late and lose. But I should say that it's not just because of the discrepancy between naive and sophisticated investors that I have my doubts about the future of crypto. Quite frankly, I'm skeptical that private cryptocurrency offers much of social value at all. It's sometimes suggested that private crypto can ultimately replace government-created money like the US dollar or the European euro. My own view is that this would be a very bad thing because a crucial benefit of government controlling the money supply is that it can conduct countercyclical monetary policy. When we're in a recession, the government expands the money supply, stimulates the economy, gets us out of the recession. When the economy is in danger of overheating, the government does the opposite. It contracts the money supply, helps cool things off. So monetary policy has meant that in the last 100 years, business cycles have been, for the most part, far less dramatic, far less volatile than, say, in the 19th century when there was no active monetary policy. If crypto replaced the dollar, private crypto, we would be in danger of returning to the days of these huge business cycle swings. Another argument that's sometimes made in favor of cryptocurrency is that it means people don't have to save their money in banks anymore and don't have to go through banks to transfer money. So we don't need banks. But I think we want to think twice before getting rid of banks, because they are and have always been a major source of lending to entrepreneurs. You might say that entrepreneurs could get their loans in other ways, maybe from crowdsourcing. And of course they could, but one advantage that banks have over crowdsourcing is expertise and experience. They have some idea about which entrepreneurial projects are likely to be profitable and which are not. Crowdfunding is naive. And so if we're going to rely on crowdfunding, the implication is that a lot of loans will be misdirected. So I really don't think we want to replace banks. And as for transferring money, it's true that currently people who don't have ready access to banks may find cryptocurrency a convenient way of making and receiving transfers, but this advantage is likely to disappear once there are crypto versions of government money, like dollars and euros. And I think we can expect this to happen. So there are many other well-known objections to cryptocurrency. It uses up too much energy. It's a vehicle for illegal transactions. But even putting those aside, I think the monetary policy and banking angles definitely come out on the side of being a crypto skeptic, and that's what I am. Let me stop there for the time being.
Thank you, Eric. I'm really glad that we started with you, because I think it's important that we get balanced perspectives. And I do think a lot of what you've shared around monetary policy, as well as around this information gap between institutional and retail investors, is very much relevant, actually very reminiscent of a lot of the issues that we've seen in public equity markets as well. And so having talked about institutional investors, love to also balance out your perspectives with those of Ray, because Ray, as you mentioned earlier, Grayscale is one of the largest institutional investors in this space. So love to hear your thoughts and perhaps respond to some of Eric's earlier points as well.
Absolutely. And not only institutional, but we have hundreds and thousands of retail investors too. I think Dr. Maskin, I think it's great that he has brought up the points of inequality and the fact that cryptocurrency is a volatile asset class. It's absolutely true. It's a nascent asset class, and this is what you see with new asset classes. The key to this, the way we think about this, is that education is really important. It's up to us as an industry to create the resources and the content to even the playing field, and to educate people to be thoughtful about how they're investing in this asset class, just like any other asset class. So thinking about their time horizon, right-sizing their investment, doing their research. On the point of inequality, look, I think that there is a lot of, certainly cryptocurrency is being used for speculative purposes, but I'm excited about the future. I think that, and we think at Grayscale, that there's a day at some point in the future where the 2.5 to 3 billion people that are currently unbanked are going to be able to benefit from getting to use cryptocurrency, and that it's going to be more beneficial to them to have something that is truly decentralized, that is not susceptible to manipulation or control by governments, and that allows them to send money basically anywhere in the world within minutes for free. So, we remain excited about cryptocurrency and its potential as a tool for financial inclusion.
And before we move on to a different topic, William, any input here as well?
Yeah, I think that we need to look at this whole thing, crypto and everything else, in the context of a monetary, if it's a monetary system, into an ecosystem, and it's another element in this whole ecosystem and how it interacts. And I think a lot of the things that I'll talk about will kind of touch on this when I talk about regulation, about fairness, markets, and the way that regulation is going to start coming into these markets, that we don't have any choice, and it's going to happen. So how is that going to level the playing field? And I also have a few examples on when we talked about fairness and unsophisticated investors and some of the consequences of people getting involved in things that they really shouldn't get involved in. So I think everyone has a good point. I think they're all important elements. I don't think it's all one or all the other.
Absolutely. I think one of the threads I'm hearing from across all of us is that oftentimes when you come across a new piece of technology, it is a means rather than an ends. There's no magic way that we solve all problems. It comes with an inherent set of issues that we need to deal with. And so I'm sure we'll get more into that for the rest of our time as well. I know we want to pivot a little from kind of the economics and the incentives underlying Web3 to also talking a little bit about the metaverse, because there's obviously a lot of attention on this more recently. And so as of the latest data, actually, Ray, I wanted to ask you more about that. I think as it currently stands, Grayscale, at least publicly, has mentioned that it holds about $60 million of mana, one of the top projects within the metaverse space. And obviously, it should be a very positive signal for where things are going, but love to hear your thoughts about metaverse. And of course, as a concept, as implementation, it's very early on, but love to hear your thoughts on where you think breakthrough to the general public might come from.
So first, I want to take a big step back. For anyone who's not familiar with Mana, Mana is the native token of Decentraland, which was the first and leading blockchain-based virtual world. This is a place where people can explore, interact, play games, buy and sell land, interact with other players, display NFTs, and Mana is the currency of this virtual world. The difference here is that unlike other virtual worlds that have existed or that exist within games, where the assets, the in-game assets, the creations are owned by the corporations or the web developers, here the players create and own their own items. And in doing so, they have a stake in the virtual world. And that's really important. And as you mentioned, by creating Grayscale, the Decentraland Trust, we've created a vehicle to enable investors to get economic exposure to the currency of Decentraland, Mana, as the virtual world continues to grow without having to own all the tokens outright and deal with the frictions associated with token ownership. When we think about bigger picture, we feel like there's a very meaningful opportunity around the metaverse. We've long believed in the potential for virtual worlds, and we've seen an increasing amount of time and money spent on digital activities. In fact, some actually believe that by the year 2025, we're going to see close to 400 billion of revenue actually from these virtual worlds. So this is a new technology that has the potential to transform the way we work, socialize, and interact with each other. And most importantly, we feel that the future of the metaverse is going to be decentralized, and it's going to afford people the economic and social freedom to own their interactions.
And of course, how the metaverse is structured still follows fundamental economic principles and incentives. And so, of course, before we pivot, love to hear any input from Eric and William as well.
Well, let me again be the skeptic in the group.
Yes.
In my view, that we face enough challenges in the real world that I worry about distracting our attention by focusing on an imaginary world. I would like to see us, citizens and political participants, get together to solve the real problems that the world faces, including inequality, including climate change. And to the extent that we're building a virtual reality, I don't think we're facing the major challenges that the world faces. Could I just come back to something that Ray said earlier? I completely take her point that for people who do not have access to banks, who are unbanked, as she put it, the ability to receive and transfer money instantly and cheaply is very valuable. But this does not have to be done necessarily through the vehicle of privately created cryptocurrency. It could be done, and I think it will be done, through government-created cryptocurrency as well. I think that's coming, if only as a competitive reaction. And the reason I favor the government approach is partly for the reasons I said before, that is, to be able to conduct monetary policy, which I think is an important policy tool, but also because I worry that we are moving away from the idea that government is there to solve problems. Too many people today, I think, believe that government is the problem, not the potential solution. And I would prefer a world where we elect governments that are responsible, and we then give those governments the power to do good things for our society, rather than to try to operate in a decentralized fashion. Decentralization is fine for some things, but for the truly important problems of the world, like inequality and like climate change, there's no substitute for government.
Absolutely. In fact, on the point of government, it very much relates to the regulatory environment as well, which I know William will be talking a little bit more about. But before we move on to that, on this point, anything that you might want to add?
Well, again, not that I'm straddling the fence, but kind of disagree necessarily about government to have the potential for good. But I think we've seen a lot of damage that the government's done, particularly when it comes to monetary policy. Because if you take a look at the debt we have right now, that's created by the government. Now we've got a debt that's north of $30 trillion and obligations that are way more than that. And anyone that thinks that well, and we're seeing some of that hitting the markets now with inflation that we see in some of the government policy we had, for instance, energy policy in the United States. I understand there's a balance between climate policy and energy policy, but it's been, I'm not a climate denier, so I don't want this show to get banned. But let's face it, fossil fuels have created more wealth in the last century or so than is the biggest factor of wealth and pulling people out of poverty over the last century than almost anything else. And if we deny cheap fuel, this is hitting Americans in the pocketbook right now. Look at what we're paying for gasoline right now. And Americans drive more than anyone. So it's a big portion of household income, heating houses and things like that. And, regardless of who the government is, I think overregulation is, and the government stepping in thinking they're doing something, there are often consequences that where political considerations are put over what common sense and the common good might be. I'm more of a principle of subsidiarity person, and I believe that government should take care of things that people can't take care of themselves, and what the next level of government can't, and let people make more of their own decisions. It's very difficult, I think, particularly in a country like the United States, where national laws might seem good for a ruling class or someone that's making it, but the rest of the country is affected because they're different. So I think people should be making their own decisions. And again, the biggest thing problem I have with government monetary policy is you just take a look at the national debt. That being said, moving everything outside of that, and particularly, I mean, look, the US dollar has been, everything is priced in the US dollar. Petroleum, most commodities would be like that. Most sources of international payments are coming through SWIFT and things like that. Those are systems that we can't break. So that structure needs to stay fairly stable, or there's going to be chaos.
Absolutely. Really appreciate that perspective. Actually, it's a really natural transition point for us to also talk a little bit more about Web3 overall, because earlier we've talked about Web3 as a form of potentially wealth distribution with its own set of challenges fitting into the regulatory framework. But if we were looking at opportunities in this space, of course, innovation is already taking place, or at least there's plenty of projects pushing forward. What do we need to do in order to make sure that we have the right framework set up for success? And what are the right things that we may be able to do so that we can enable this to go mainstream without falling into the traps, some of which we've covered so far? And this question really is to everyone. So Willem, you're welcome to continue, or Eric and Ray, you're welcome to jump in anytime as well.
I'm fine. I just think, look, everything is going to be subject to regulation. That's where government can do a lot of good, because, as long as it's reasonable regulation to help keep a level playing field, I think that's what government's role will be in any of these markets that's coming in.
I agree. I think that there are players within the cryptocurrency world and, within Web3 that operate within the regulatory frameworks. We're one of them. 9 of our products are SEC reporting. And that's why we have these agencies. They're meant to protect investors and require us, the issuers, and anybody that's creating and selling products to, ensure that the right amount of disclosures are there, and that, folks are selling products in the ways that fit within the existing regulatory frameworks that are there to protect the public.
You won't be surprised to hear that I'm definitely in favor of regulation of cryptocurrency in particular, or for that matter, any other kind of asset. Financial markets actually, compared with most other markets, are especially important for regulation. We don't need to have the potato market regulated. We don't need to have the wheat market regulated, but financial markets are different from normal markets in that small failures, small problems tend to get blown up into big problems. That's what happens in the 2008-2009 financial crisis. We had a small problem in a tiny part of the mortgage loan market, namely the subprime mortgage loan markets, small fraction of the overall financial markets, but it it got magnified. It got magnified because of leverage. And so one very important role for governments is to keep a handle, to keep a lid on leverage, to see that the problems of 2008, 2009 don't repeat themselves.
Absolutely agreed. Of course, we've talked a lot about the regulatory environment. We've talked about underlying incentives. Would really love to recap our discussion so far, which was high-level thoughts and ideas of the biggest opportunities that we see and the biggest challenges. And I really like the fact that on this panel, there's a balanced perspective. In terms of just kind of high level, if you were to observe and name the one biggest opportunity and one biggest risk that each of you see, would love to hear from you what you think those are.
Well, I think the opportunities are, there's no denying the exponential growth that's coming to technologies. I think the biggest risk is that, as Professor Maskin said, there's not a large universe, or it's not, as far as participants and the ability to participate, as far as being sophisticated enough to take advantage of some of these new technologies, me included. I mean, I'm afraid of Bitcoin. I have more like what are they called? Stable
coins.
Stable coins, yeah. But what that does for me is it allows me to move money seamlessly in certain times that I want to do, when when maybe the banking system is closed, or I need to move some money because I do global transactions. So for me, I see the benefits of both of them. But I think a lot of the risk is people getting into things that they don't understand. So when you talk about retail investors, perfect example was back in 2015 in China, when the Chinese stock market had a bubble. Now, why did it have the bubble? When I looked at it, because it affected me because I had a Chinese trading company, not in equities, but in gold. And there was a parabolic move in 2015 where everybody in China was talking about how they can make money. It was almost like during the dot-com bubble. We go to get gas pumped, and the guy couldn't pump your gas because he's on his phone trading tech stocks, because everything's going up. And that can't be sustained. The same thing happened here in Dubai back in around 2008 with the real estate market. A guy asked me if I traded gold for him or managed something, what kind of percentage do I think I could make for him? And whatever I said, he said, "Oh, we're making 40% a year in real estate." Well, that's a one-way market. That can't last. So bubbles get created in the markets, and bubbles have happened all throughout history. So what happened in China was, in March of 2019, there were 4 million brand new accounts opened to trade equities, people that had never traded before. And I think Bloomberg did an analysis of that. They said 2/3 of those people did not have high school educations, and about 6 or 7% were illiterate. So now, what are these people? They think, I'm going to make money, I'm going to make money. They're very unsophisticated, just going to go in and buy. And if you take a look at the top of the Chinese stock market at that point, it was in March of 2015. So that was a sugar rush of buying that came in with irrational investors and unsophisticated. So what happened is the market collapsed. What seemed like a market collapse was just a giant correction, because if you take a look at that, it went back to its fair value, and you can see the market going in a slow bull market in an orderly fashion. But what happened in the regulatory part? Okay, so the Chinese regulators at the time put in draconian restrictions on particularly the CSI 300, which is the stock index future in China. That contract went from trading 2 to 3 million contracts a day down to 20,000 a day. It pretty much shut that market down. Okay, so there was maybe an overreach there, an overreaction, but the regulators are also, particularly in a country like China, they're very sensitive to political realities. And the government's very sensitive about a large part of the populace losing money. So again, you had unsophisticated investors into that market, it came down. I see that can happen at the same time. With the volatility in Bitcoin and things like that, if you don't have the wherewithal to withstand downdrafts and things like that in the market, it can be very, very painful for people who are undercapitalized or unsophisticated. Now, there are two different ways of looking at it. As a trader, if I'm a trader, I love volatility. If I'm an investor, I may have second thoughts about it because it creates more risk. Investors need to be more risk averse. Traders want to accept more risk. So it depends on where you're looking at it.
Absolutely. And before we move on, Ray, Eric, any additional thoughts here?
Yeah, so I mean, to your point, I'm definitely not a trader. I'm an investor, and I have learned to be very patient and live with volatility. And that's what we hope to help others do by understanding the way to right size their positions, have the right time horizon. I think the opportunity is the development of a financial system that really serves everybody, including those that have not traditionally benefited from a sovereign owned and sovereign controlled financial system and monetary policy. And I think that that's really exciting. I think the risk is that, people don't put in the work to educate themselves, to use the resources at their disposal. And, there are bad actors out there. There is a lot of noise out there. And I think the risk is that because of that, fear of innovation, fear of volatility end up ruling the day. And that would be a shame because there's a tremendous opportunity here.
Eric, I saw you starting to speak earlier as well.
Let me just oops. Let me just say that for me, the most welcome opportunity is something that I was talking about before, which is a public alternative to the private cryptocurrency that has already been created. My view is that if we have a crypto dollar or a crypto euro, we will have all the benefits of easy transactions without the risk and volatility that these private creations are causing. So that's the innovation that I would like to see.
And I think government has the opportunity to compete that way too. And I think it's going to happen. It's really interesting. About 2 hours ago, I have a partner in Seattle, and he gave me a call. He said, "You're not going to believe this." He was a White House fellow, and he was looking at someone's resume. I don't know what they were doing, but this was somebody that from a large investment firm that was, I don't know if she was applying for a position or something like that, but she wrote a detailed recommendation on exactly that, on what the United States should be doing to develop a cryptocurrency. And I think it's positive. I mean, look at what's going on in China. China's ahead of the game on that as far as most people go, as most countries go. And I think it's inevitable that that's going to happen. And then the market's going to decide what's going to work.
Yeah, I really appreciate all of your perspectives. And I do think it's great as a panel that it's a very balanced perspective. And in fact, as we were all talking, I was writing down some of the key points because I know afterwards the organizers are hoping to post this video. So if we have any additional follow-ups, I know there's folks that are going to be reaching out. pivoting a little bit, I know one of the questions that folks wanted to ask, well, actually originally supposed to be directed at me, but I'd love to get our group to discuss it, was really focused around really where we left this last conversation around new ideas and innovation and seeing where markets can drive this innovation. So in the past couple of years, we've seen a number of really successful entrepreneurial projects emerge, like Mana, we talked about earlier, like Sand, including our event sponsor, Shadow Killers. And so the question was originally directed at me as an investor, early stage investor in the space, what elements are most attractive when we look at new projects, and any interesting technologies or concepts like decentralized autonomous organizations that have the potential to restructure the foundation of Web3 and the metaverse. So I maybe will try to set some foundation to this question, but love to get everyone's input on this as well. So while we've invested in a number of blockchain-enabled companies, it's really not the exclusive focus. We really focus on future of work and enterprise SaaS at the core foundation. So when we look at opportunities for new investments, I wouldn't say that I assess blockchain companies any differently than we do any traditional company. If we were to really look at the foundation of any successful startup, there's really only three core things that any business needs to do really well. And that is to raise money, make money, and hire people to make money. So if we were just going back to the foundations of what a business is for, technology doesn't by itself solve all problems. Like even earlier on the panel, we were talking about technology as a means, but not the ends. So I think it's really easy now to see projects that will throw words like metaverse or Web3 or blockchain or crypto as kind of buzzwords. But beyond the buzzword itself, when we look at the foundations, does it really make sense? So when we talk about DAOs or decentralized autonomous organizations, I think it's really interesting to think about leveraging technology to automate how the business runs. And we're actually doing research now here on campus at UC Berkeley, where we want to look at not just the governance and legal implications, but also what are the financial valuation implications of DAOs? How do votes get made? What percentage of voters actually influence where the votes go? So it's very much analogous to a lot of what's happened in public equity markets as well. We've certainly seen people be very creative to try to influence votes. Like in public equities, you certainly see people borrowing stock at the right time so that they have the voting rights associated around certain decisions and then try to vote as a block. And we certainly see that around DAOs as well. So what are the implications of that? And then ultimately, how does all of this go when we look at the regulatory foundations of it? So I will kind of leave the foundation there as is, but love to get all three of your input on what your thoughts are on what you might look for judging whether or not something is at least a project in the right direction, and how you can see technology being as an enabler for Web3 and the metaverse.
I would kind of have a question for you, Shuo, is that when you talk about these voting rights, and I'm thinking of traditional markets and traditional securities laws and regulation, well, how subject is that into what we would term insider trading?
Yeah, so I think actually a lot of what we've seen in blockchain-enabled markets, at least in the early days. So I'll first take a step back and kind of talk about what I've seen in the past, and then William answer your question directly. So when I think back to the early days, including now, I think we're still in the very early stages. It actually is very much reminiscent of the early days of the public equity markets. When we think back to actually back then, when stock markets were created, it was a very controversial concept when it was first introduced, because what do you mean anyone can own a portion of a company? And there were certainly many people who were retail investors and were not sophisticated institutions, and unfortunately lost their life savings in the early speculation and volatile markets of the stock markets. Of course, now we still see penny stocks and other types of stocks like GameStop being highly volatile when there's a lot of speculation involved as well. So I think that it's no different when we look at crypto-enabled companies and tokens. So I think it somewhat goes back to Eric's earlier point as well about how, regardless of what this new terminology is, the fundamental economics are the same. So I think when I think about this, I do think that when it comes to regulation, there needs to be more sophistication around how do we apply similar logic and analogies to how we think about blockchain-enabled markets. So then on to your question more directly, William, when it comes to insider trading, in the very early days, we certainly saw insider trading the very same way that we saw insider trading in public equities when stock trading was a new phenomenon. And of course, within crypto, you have this term called whale investors, who are the really large investors who hold huge portions of specific tokens. So I think that's certainly still true, depending on what specific projects we're looking at. So I do think, though, that there are some new initiatives that are emerging where we see a lot more transparency. So when we look at DAOs, some are quite transparent. When you look at the structure and all votes are public, they'll tell you specifically how many votes were given to one particular suggestion or what types of proposals. So typically proposals will fall into a couple of main categories, whether it's a technical, let's fix a bug, to governance, how many tokens need to be staked, for example, in order for this to happen, or what are the exchange rates for something. And then some are other suggestions for improvement to the whole mechanism overall. And most of the time you can see how many people voted, who voted, and then who just didn't vote, and this passes. And you can also look into, based off of these DAOs, is the default that the vote passes if not enough people vote, or nothing passes unless you reach quorum? And what percentage counts as passing? Do you just need a majority, so 50.1%, and you're good? Or do you need to reach, for example, 80% and above in order for something to be approved? So I do think that with more transparency that's enabled by technology, perhaps there is a chance for more efficiency for us to at least be able to access this kind of information. Because at least in public equities, it has been difficult in the past for retail investors to even have to process through all the different financial disclosures that come out on a quarterly basis. For the average retail investor, I think it's very hard for us to find anyone who, say, is an investor in Google who has read through all the Q1 or Q2 docs that come out after earnings reports. So I do think there is a chance for more transparency here, and at least more UX, user-friendly UX for this type of information disclosure. But I'd love to hear all of your thoughts as well.
Yeah, I think what you said, you know, every market, you talk about the innovations in markets, as you mentioned, how can I own a piece of a company just by buying shares of stock? That was novel. When I look at, like, when the futures market started, trying to explain to people what short selling is, you know, and the futures markets are really there to manage risk. So it really started, you know, back to manage, so they weren't dumping wheat in Lake Michigan because they couldn't afford to store it. You know, you could manage your price risk, and that's really what it's supposed to be for, and then provide liquidity. But trying to explain, even when I started, I was working with farmers, and when they would put an order in, they wouldn't say sell if they wanted to go short, to put their hedge on. They'd say buy it to go down. So I had to know how to do that. But that whole thing, so, you know, there is a thing, and I admit that now there are a lot of the things that, you know, that are in this universe that we're talking about are kind of foreign technology-wise or terminology-wise to me, you know. But once it's explained, which I thought you just did a great job, I understand more about how that works. But the regulators are going to jump in, believe me. So, you know, for instance, like Ray, what do you think of what just happened with BlockFi?
You're muted, Ray.
Sorry, I was muted. Look, like I've said before, regulation is important. Regulators are going to do their work. They're going to step in where they feel that it's necessary. And, you know, we think that anybody that is active in the space should take the steps preemptively to operate within the regulatory framework. And we've done that. That's what we've done. And that's, you know, that's what I would suggest that everybody does.
I'd like to make a somewhat different point, as usual. We've been talking about transparency and new technology. I'd like to argue that one of the advantages of new technology may be to contribute to privacy when privacy is called for. That is, complete transparency is not always conducive to economic efficiency. And the sort of problem I have in mind came up with the FCC spectrum auctions, which have been taking place now for 25 years. You'll recall that the idea here was to take radio spectrum frequencies and allocate them to telecom companies, because telecom companies can make better use of this spectrum than the government can. The government previously controlled basically all of the radio spectrum. Now, the licenses which gave companies the right to operate on particular frequencies were sold off through an auction. But the problem with running an auction is that in the course of bidding on spectrum, a company might be revealing critical information to one of its rivals about how it evaluates the spectrum. Typically, rivals want to keep certain information to themselves. They don't want to give their competitors an unnecessary advantage. But in an auction, in a traditional auction, it's difficult to keep information about your valuations for spectrum to yourself. Well, one exciting possibility with new technology is to allow auctions to take place in which you can keep your valuation private. You might disclose it, but it will be encrypted in such a way that nobody else who doesn't need to know what that valuation is will learn it. That, I think, is one of the great promises of technology. It's not moving in the direction of transparency, but it is moving in the direction of greater economic efficiency.
I think that's a really fascinating point that you've brought up, Eric. In fact, I think that raises a really great point when we think about broadly what different types of companies there are out there. There are companies that are built predominantly based off of a technological advantage. There are companies that are predominantly built upon network effects. So if we were looking at a social network or if we were looking at a community, their advantage is not so much based off of they can build technologies that others can't, but the fact that they've gotten a group of people together to agree on sharing something in common, whether that's photos or something else. And of course, there's many types or categories of companies. And I think the eventual hope is that for at least the topic of our discussion today, whether it's Web3 or Metaverse, that we are progressing towards an environment that is more efficient. And whether more efficient means more or less transparency is going to be really up for our debate and what we've really been talking about a lot today. And it actually really brings us to this question one of the co-organizers really wanted us to ask from Duke University MBA Crypto Club. They really wanted us to discuss what we think traditional consumer retail companies should be doing to make the most of Web3 and Metaverse. And it falls in perfectly with what we're talking about here, because we've talked about for example, your latest example, Eric, with Spectrum, that's obviously more in a different category than, say, a traditional consumer retail. So love to also hear your thoughts on how you think that might apply to the more traditional consumer retail companies.
Well, imagine imagine that you were interested in selling some private good, some traditional good in an auction. People do this all the time. They sell their homes through auction. They sell rare paintings, rare any sort of good where there's a very limited supply, and so ordinary competitive markets don't come into play. In any setting like that, where there are people bidding on whatever it is you're selling, those people may be reluctant to let other people know what their bids are. And so even private companies who are selling things at auction will benefit from the new technology, which allows privacy to be maintained.
I think for
I
me,
think that's a good point. Oh, go ahead.
oh, I was
Go ahead.
going to say it's, I don't know that I could opine on what anybody should be doing, but what we know is that increasingly as consumers are in the metaverse, they're in virtual worlds, so too will be the people that are trying to sell stuff to them. And that's, Facebook literally rebranded to Meta. And I think that's a really good example. I think it'll be really interesting to see in 2022 how corporations start to get more and more involved in the metaverse, because that's where their consumers are going to be. And, I feel like they're going to do whatever they need to continue to stay relevant for their consumers.
And William, you had something you wanted to pitch in on as well.
I thought, Professor Maskin brought up fine art, and with these, I've been reading more about the NFTs that are going on, and Sotheby's is involved in that, and I think that's a good way of looking at some of the things. The other thing, like take the art market for example. When you talk about, let's talk about AML. That market's been notoriously the physical art market as a vehicle to do money laundering. Okay, that could be mitigated to some degree with NFTs, because if you're going to monetize that, you're going to have to go on to an exchange, Ethereum or something like that. And then you're going to create some type of, so I think that would keep these markets in line where they can't, you don't have subjective valuations on something that you can just say, it's worth this or it's worth that. There's going to be an actual market for it. That's one advantage I see to that. And also, maybe some of the privacy that might go on with that as well. I mean, there are issues. You see abuses in these things right now. You see a lot of wash trading going on in that, even though it's a small market. So that's something that if we did it in and I think as Eric rightly says, the real world, you're going to get in a lot of trouble. So it's a new frontier, and I really don't know which way everything is going to flow, but it's here, and we're going to have to deal with it.
Absolutely. And as a last point, I guess, on this conversation around data privacy and to what extent do we want things to be transparent, as a technology, at least for blockchain as underlying technology, of course, there's a number of versatile ways in which you can design the network. You can obviously design a network that is fully private, that is not that different from, say, more of a traditional data network. You can design something fully public, or you can design some sort of hybrid network where certain information is available. So hopefully that helps mitigate some of these data privacy concerns. But of course, then the underlying question is about alignment of incentives among the different stakeholders that partake in any ecosystem, whether that is in the case of a bidding process or that is in the case of any other transaction that might take place. So I think there's a lot more that we can, of course, dig into. And we've talked a lot about everything from foundations to even direct applications in the past hour. I thought maybe as a parting point for all of our for all of our participants at the event, perhaps each of us could leave something as a next step, an action step that participants can walk away and do more about, whether it's a resource that they can read more about or a newsletter they can subscribe to, any resources that you might recommend.
We put out, so at Grayscale, education is part of our mission. We put out a lot of content. It's on our website. Feel free to check it out. You can reach out to us, info@grayscale.com, and you can absolutely subscribe to all the research and the newsletters that we put out there. But again, we've created a lot of content to help you all and everybody that's out there that's thinking about this space or thinking about making an investment or getting involved in some capacity, have the right tools and the knowledge to do so in a well-informed way.
I think your website does a good job in the educational thing. I think you're a responsible citizen in that regard, because it's as much trying to sell someone, you're trying to educate someone, and I think that's important. And also, but one thing I would leave you with is that I expect there's going to be more regulation. Even some of the things that we just saw this week. Chairman of the SEC, Gensler, last August kind of indicated that they were going to start targeting some of these things. So they went after, I think the first thing they probably went after was the lending on the cryptos. So you saw Coinbase kind of drop their plans to put in their lending program. And then that's what BlockFi, their product that gave a return, it wasn't properly registered. So I think you're going to see more and more involvement on the U.S. side, mainly by the SEC, is going to come in and start taking a look at things, which could be good. And I think so the challenge for companies are going to be to have robust compliance departments and compliance procedures, AML, KYC things, just like traditional brokerages would and traditional institutions would. So some of those things are going to be more universally applied, and I think I don't think that's going away.
Let me just mention that the skepticism that I was voicing this evening is not held by me alone. There's a sizable group of economists, including some of my fellow Nobel laureates like Paul Krugman and Joe Stiglitz, who have voiced similar concerns. As part of educating yourself about these issues, I would suggest that you, for example, take a look at what Krugman has said. He publishes a column a couple of times a week in the New York Times, and he's written on crypto quite a lot.
Thank you so much for that. I think it's all really helpful because it's a balanced perspective. So for anyone to make informed decisions, of course, the more that you learn, the more you educate yourself about the space, the better you can make an informed decision. And of course, I'm sure the co-organizers of the events today, Silicon Valley Crypto Club, Duke University MBA Blockchain Club, Shadow Killers, they all have their resources as well. Obviously being on the faculty at UC Berkeley, we have a ton of content that's put out through the university as well, where we have a number of courses, whether it's ranging directly to the economics underlying a lot of the crypto tokens that are established, or ranging all the way to just fundamentals of the technology and how it works, what problems it's effective at solving, what problems it's not effective at solving. There's a ton of resources you can find through UC Berkeley as well. I personally also sit on the board of one of the largest nonprofits, actually the largest nonprofit that's co-organized between Berkeley and Stanford, called Decode. And there's a ton of available content, both written as well as on YouTube. So if you're interested in checking that out, feel free to search for Decode Space Build on YouTube as well. I think it's helpful to just educate yourself on as much of a wide range of materials as possible, so you get really opinions from all across the spectrum. So really appreciate all of our amazing panelists' insights today. I think we've covered so much ground for the short span of an hour, and really appreciate everyone staying longer past our hour to wrap up our conversation as well. With that, a huge thank you to all of our amazing panelists, to the event organizer and our sponsor, and last but not least, to all the participants that have joined us today. Hope you all have a happy, healthy, and safe rest of your evening. Take care, everyone.
Thank you.
Bye, thanks for
Thank
having
you.
me on.
Pleasure.
Bye.
It was a lot of fun. Thank you so much. Bye-bye.
Bye-bye.
Thanks so much.